I often get inquiries from non-residents wanting to sell their property in the UK, but they don't know the questions to ask. They might go into ChatGPT and ask, what is the tax? What is the likely tax on such and such a selling price, etc. But they don't have. They're not entering all the information into the chat. And the chat is not able to determine what the client needs to know. I have a, I spoke to someone quite recently who'd got all the information he thought he needed from Chat GPT, excuse me. So he was planning on returning to the UK, but he was thinking of selling the property while he's non-resident. And there's a lot of nuances there, but also the thing is that he was in Australia for a reasonable amount of time, where if he returned to the property and stayed within that property for a quality period of residence, which courts have recently established as 91 days. So if he were to stay in the property, return to the property after his period of working overseas, then he could possibly be exempt from capital gains tax altogether. And a chat GPT is not going to be able to highlight this feature. So therefore, it's important to speak to a tax advisor in the first instance.
So I ran my own little experiments as well, and I had the same result. I put in the details of a property I sold and pretended I'd lived abroad, but it didn't talk to me about the rebasing of the property valuation in April
Yeah.
2015. It didn't ask me questions about what, it just basically went straight to, do you want to file this? Here's the information you need to file it. Here's your tax calculation. Do it within
So
60 days.
yeah, rebasing is a key feature, especially if you've been out of the UK for more than 5 tax years. It's not going to work if you're going to return to the UK within 5 tax years. Then, within the year of your return to the UK, you need to correct what you've reported previously and have your capital gains tax assessed against the original price. However, what I'm referring to is, as a major concern here, is principal private residence relief, PPR relief, which I read just recently as saves the taxpayer £27 billion a year, actually, because it reduces their exposure to capital gains tax for the amount of time they've lived in the property. But also within tax law, you are allowed periods of absence from those properties as your main residence if you are working full-time overseas without any break in overseas work, and return to the property once that assignment comes to an end. And then a further period of absence is allowed if for any reason whatsoever for the first 3 years. And so these things are quite important, and they're not necessarily highlighted by Chat GPT if the question is not asked. Chat GPT will only answer the questions that are asked and not indicate the subtle nuances that the taxpayer needs to be aware of. So that's where I step in. So a capital gains tax return, once you sell the property, needs to be declared within 60 days. The CGT return needs to be filed within 60 days. These people might go ahead and do it themselves, but then later on they might find that they've made a mistake, and then they come to me and ask me to help them correct it. And they might find that they've overpaid capital gains tax as well, and that's quite a process to get back to recover. So why get it wrong in the first place? I think really the best solution is just to get a tax agent involved and make sure it's done correctly.
Yeah, and so I concur. Like, I mean, obviously, I concur. It's what we do. But from my understanding, obviously, there's also elements about your resident status and things like that, which again technically all of these things you can do yourself, provided you know what's going on.
So there are mixed residency rules also that should be considered. Let's say the property is jointly owned. The husband is in Holland or Australia on assignment. So the husband is absent from the property for 3 years. And then let's say the the wife remains in the property. So PPR relief will still be available to the husband because of mixed residency rules that exist. So these are things that need to be researched as well in greater detail. And we need to see, we need to do the appropriate level of analysis and research there. Also, if people, some people are non-resident based on the number of days they are overseas, etc. And they could possibly spend more than 91 days per tax year in the property. And in such a case, then there is scope for PPR relief also to be obtained or to be claimed for the entire tax year. So all these subtle nuances need to be considered, and I do not think you will find that level of detail anywhere on ChatGPT.
Is there also an element there from what you've described? So people have obviously got UK properties, loads and loads of expats, non-residents, and foreign nationals who have previously been in the UK, have moved abroad, have UK properties. Essentially it's either a fallback or it's an investment, whatever. If you're not planning to sell now, so we've talked like this is kind of an element. What we're talking about here is kind of an element where you're at the point of, right, I'm looking to sell, or I've got an offer and I'm actually in this process. I've sold, I've completed, I've got the funds, I need to do the tax return, I've got 60 days, off we go. But if you have a property in the UK that you're living abroad, but you're not planning to sell now, but you know that you'll sell in the future, these are elements that, again, you can actually think about and say, well, actually, if you were to do these things, so private residence relief, for example, right? Well, if you did this behaviour, you could then claim for that at the future point. Where is that an option for people? Ultimately, this
That
is
is
proper forward planning.
that there within the legislation or within the HMRC manuals, there is scope for claiming PPR relief if you're in the property for more than 91 days per tax year. Yeah, so there is that scope. A lot of properties, investment properties, are Airbnb properties. You know, the owner might want to be in the property as well for a period of days during the year, and you might find that I haven't come across that yet within my own experience, but it's something I would research. I'd want to research to make sure that if the owner has been staying in the property for a reasonable amount of days within each tax year, then I would want to explore if PPR relief was available to the taxpayer. So there are a lot of people who are just selling investment properties. They've never lived in the property. In such cases, PPR relief is not available to them. But because they've been non-resident, if they satisfy the criteria and to be deemed non-UK resident for at least 5 full tax years, then they will benefit from rebasing. And you will find that a lot of people who've owned property prior to 2015, you will find that those property values reached a peak in 2015. And then with all the Brexit uncertainty, especially in London, you'll find that property prices stagnated. And so property prices 10 years later in 2025 will be very similar to 2015 values. And you'll find that those people will experience almost no capital gains tax or very little capital gains tax on selling their properties while non-UK resident. And that is quite an opportunity for non-residents. So we've got residential property, but we've also got commercial property. I've got clients who sell commercial properties. Their husbands have passed away and passed on shops to them, etc., and they sell the properties. And those properties are rebased not at 2015 values, but at 2019 values. And I've got a few clients as well who sell land. Land falls within commercial property, and again, land is only assessed for capital gains tax from a 2019 rebase value. So those are. This has created quite a good opportunity for non-residents who want to sell those investment properties. And also, of course, there are non-residents who are selling formerly owned, formerly lived in, formerly occupied properties. There's no risk of them returning to the UK, therefore they're not going to be entitled to any PPR relief, but they're going to benefit from the 2015 base value. But you might find, and I wonder if ChatGPT can do this, you might find that they might benefit not from, because they've owned the property since 1992, for instance, they might benefit from a straight line apportionment rather than doing the 2015 rebase value. And that's where a tax advisor is useful, because the tax advisor will work out what is the best calculation method available to the non-resident. Do we take original price and PPR relief, or do we take the 2015 rebase value, or do we take straight line apportionment? Straight line apportionment means we've got the gain over, let's say, 20, 30 years. We'll apportion that gain per year or per month, and we'll all take those months where CGT, where the taxpayer is exposed to CGT from 6th of April 2015 onwards. So you might find that the chargeable gain arising over a 30-year period is much less than rebasing it at the 2015 value. So there's a lot of things to be considered, and they're certainly not considered by a random check.
So, and actually, just underlining that, a few of my friends who are kind of researching, and obviously I'm looking into it as well because my business is very, very online based. So therefore, how is AI going to impact? And while I do talk about AI a lot now, the other thing that is really becoming clear is that it's very much or at this point in time, it's very much a confirmation bias problem as well. So it will tend to agree with you. So if you is that all are these all the options that that are available, it will kind of typically go, actually, yeah. But what I did when I was running my test was to say, how confident are you? How reliable is this information? And essentially, it came out about 70% reliable. And it's like, well, that difference is huge, really, when you're thinking about the potential cost of capital gains tax and overpaying and getting that money back, or potentially penalties if you get it, like if you're underpaying because you assume something that incorrectly. The impact of that is huge, right?
It's very difficult to get the money back if you've overpaid. I've got one client in California who's overpaid capital gains tax. I'm trying to help him recover. But the only way he can do that is by sending a letter to the CGT team. The CGT team seem to be separate from the income tax team. And even though the self-assessment, the annual tax return might be showing the overpaid capital gains tax, it's not getting refunded until the capital gains tax team are involved. And you'll find that these two departments, they don't seem to talk to each other. So it's quite a lengthy process. So and involves a lot of letter writing, not phone calls, but letter writing, and that's a long drawn out process.
Uh, so the question I have is, we've talked about like I've kind of like hinted about forward planning, and at what point do you want to start thinking about capital gains tax? I mean, anybody who's got a property investment or investment in property, they're going to be thinking about capital gains tax most of the time. If they're non-residents, and I would imagine if they're non-British, non-resident, they don't necessarily know about capital gains tax when they live abroad because this is just an assumption potentially, but at what point should you be going, do you know what, I need to ask this question anyway. I need to make sure that I've got this right. Obviously, you might go to AI first, but at what point should you actually go, do you know what, the nuance here is so great, I have to talk.
Yeah.
I have to talk to someone.
Well, tax exposure is always something that you should understand from the early stages. So if you're considering putting the property in the market, I find a lot of clients will contact me at that point in time and they want to understand what is the reporting obligations involved if they were to go ahead and put the property in the market and to sell it. So the earlier you know what to expect, the better. Because I don't know if the market now is a buyer's market or a seller's market, but if you have to drop the price, you need to understand what's involved. And if you've got tax exposure that's going to be eliminated possibly through understanding your entitlement to straight line apportionment or to the rebase value, etc., or PPR relief, then that will tell you that maybe you don't need to demand such a high price, because the tax exposure is minimal. However, with a lot of my clients, I find that I have to prompt them to understand what is their tax exposure in the other country, in the other jurisdiction, such as Australia, etc. Are they exempt from capital gains tax or are they not, etc.? It's all. So I say that even though you're minimizing exposure or have got no exposure to CGT in the UK, you need to understand what is your exposure to CGT in the other jurisdiction. In New Zealand, for instance, I'm not qualified to comment on New Zealand tax law, but I understand at the moment CGT doesn't exist in New Zealand, but it still might be on the horizon. It might be introduced in due course. So those New Zealand residents who are selling UK property at the moment, their only focus is to minimise the CGT exposure in the UK. They do not need to worry about the CGT exposure in the other country. So it's a double-edged sword. You might end up paying no tax in the UK, but you might have a lot of tax to consider in Australia. And the sooner you know that, the better, because it helps you with any offers that you might receive, whether or not you can assess them to be within your acceptable thresholds. I find a lot of clients that they're very on the ball, very efficient. They come to me as soon as they get the completion statement. They want their capital gains tax return filed immediately, and these are great clients to work with because I want to match their intensity. They want to be as efficient as possible, so I will give them the same efficiency. But I find that a lot of clients, I prepare them in advance. I help them set up so that they can file the CGT return as quickly as possible. There's a lot of steps to take to register for CGT. And then you need to get a valuation of the property as at 5 April 2015. HMRC recommend a RICS valuation from the Royal Institute of Chartered Surveyors. I will recommend that to the client. They will find someone and who will give them a valuation for about £600 or £700. No matter where they are in the world, they'll find someone on Google perhaps. And then there's the opportunity to look at rightmove.co.uk to see what other transactions were made within the same postcode area within the 5 April 2015 time frame. And then there is the opportunity as well to go on to a website called hometrack.com and get a home tracker valuation for about $19.99. And so with those three, we can find out if what valuation makes the most sense etc. And if it's acceptable to the client too, and that will influence the amount of CGT that the person is exposed to. So early preparation is always recommended. So there are a lot of people as well. They build a property, they create another room. They buy a property, they create another room within the property. This kind of data is not necessarily shown in rightmove.co.uk, etc. So property enhancements. This is another thing to consider. Property enhancements that enhance the capital value of the property, they can be taken into account when considering your capital gains tax. The policy is that capital gains tax, home improvement costs, capital costs, they need to be substantiated. So if HMRC were to ever do a review, you need to have all the backup of the documentation on file. I find that a lot of clients might say, I can account for 50% of it. I can't account for the remaining 50%. And I will say, well, let's drop that 50% and we'll just include all of the costs that you can substantiate. In the event of an HMRC review, that would be very important. Otherwise, HMRC would then do their own calculation according to what records they've got, and you might find that there'll be extra capital gains tax to pay with penalties involved, etc. However, there are a few people, and this perhaps can be a warning to them. There are a few people who do home improvements through family and friends, etc., and they don't have any cost
cash in
to
hand,
substantiate.
maybe.
That's it. Yeah, absolutely. There's people who want to avoid VAT, etc. So they don't have any backup, and that's a waste of time because it doesn't benefit their capital gains tax calculation. So it's important to do it professionally, do it through a good audit trail, and if you've got that audit trail, then that will certainly be taken as a deductible against any chargeable gain. All
I mean,
right.
that in itself is an interesting point. So recently, I was chatting to another partner, Laura, who we were talking about statutory residence test, and one of my questions was, well, who checks? Who looks for the evidence? What's the chances? And it's like, well, not everyone gets checked, but you never know,
That's right.
and it's
Hmm.
not worth like having your pants down when HMRC comes looking because they're gonna take action and it's gonna hurt. So it's like don't take a chance.
Yeah. Well, I mean, I've got a lot of comments to make there, but let's keep the focus on CGT.
Yeah, sorry, I'm not very
Yeah.
professional, Laurence.
Excuse me. No, I'd love to say a lot of things there too, but SRT is another big issue. However, hopefully for these people who are claiming to be non-resident, hopefully they can substantiate the fact that they've been non-UK resident. And but in the majority of cases, people are overseas for work. They're working full-time overseas. They're in the UK for less than 90 days a year. They've got no significant breaks from overseas work. Uh, if that works, then they're non-resident and they're non-resident for at least 5 tax years, then they're going to have the capital gains tax assessed either as a rebased value in 2015 or straight line apportionment or against the original price. Another thing I want to say is if you're going to go against the original price, then those original costs incurred like stamp duty, legal costs and acquisition, etc., they can be offset against the chargeable gain. However, if you're going to use the 2015 rebase value, those original costs, any costs, even capital costs incurred prior to 2015 cannot be included within the calculation. But if you're going to use original price, you're also going to take into account PPR relief for the amount of time you lived in the property, plus the final 9 months of ownership. That will be allowed as well. The final 9 months of ownership, if you've once lived in the property, will be allowed for PPR relief, for main residence relief. Okay?
this is all like this is fascinating. I mean, obviously, I've worked with you for a number of years, and capital gains tax is by far the most common tax question. We get loads of questions about residence planning and things like that. But we've run webinars on it, we've done videos on it, but it's a subject that is just so important because it affects everybody, and it's not cut and dry. And I think
Yeah,
this is where
absolutely.
I look at like what's happening with AI and things like that, and I just go, blimey, people are taking a bit of a risk right now, especially as HMRC are trying to make sure that they actually capture more people. Well, capture's the wrong word, but their net is widening because they want there's a lot of potential revenue being lost, and they want to claim some of that back. So hence the nudge letters, hence
Well,
all
yeah,
things like
this
that.
is yeah, absolutely. This is what I went, in the beginning of the conversation, I talked that PPR really represents a saving of £27 billion per year for the taxpayer. And because of it, we find that there's a lot more cases now going to the tribunal because there's a lot more capital gains tax to be collected that's been um, understated, so to speak. You have to be careful there, and it's very important, therefore, to involve someone.
So I mean, the thing that I kind of get here is that it's always well the cost, the potential cost of getting it wrong is is quite significant, and actually the cost of getting someone to make sure you get it right is insignificant compared to that potential error, right? You might get lucky, it might kind of like all come up Millhouse, but at the end of the day, if you're willing to just pay a little bit of money, and it's in terms of the grand scheme of things, if you incorporate it into the sale of the house itself, then it's just part of your expenses in terms of making sure that you get it right.
Yeah, that's a good point. A lot of people ask, are my fees for the capital gains tax return deductible from the chargeable gain? But that's not the case. Other costs are acceptable, but um, as far as I'm aware, HMRC do not accept the cost of the tax advisor.